You a visa holder who lives in the US and has taxes, cross-border financial planning on his or her mind? Well, you are not alone. The topic of should you stay in the US or return to your country of origin is one of high importance. Hi, my name is Zhaneta Gechev with One Stop Life Insurance. I specialize in a life insurance for foreign nationals and H-1B visa holders in particular. And I'm very excited today to have the opportunity to ask some of the most common questions we've received from our chartered accountant in India. Abhinav, thank you very much for joining on this call today. And would you mind briefly introducing yourself?
Sure, sure. Thank you, Zhaneta, for having me here and taking this initiative for this session. Thank you so much. I'm Abhinav, and I am a chartered accountant from India. I qualified in 2004, and I have 21 years of experience in corporate risk management, insurance compliance, cross-border tax, FEMA, and I basically advise high net worth individuals with their cross-border India-US tax issues. So that's a bit about me.
I think we have a lot to cover, so let's just dive
Sure,
straight in. Now,
sure.
the first question is, if someone is living in the US as a visa holder, do they have any continuous tax filing obligations in India?
Yeah. So basically, in India, for non-residents of India, the taxation is basically source based. India income, if they have, they are liable to pay tax on the Indian income. Now there are exemption limits that, like, below 4 lakhs you don't need to pay tax. However, there are certain incomes of non-residents, like capital gains or dividend income, which either they do not have any exemption limit, or they have a flat rate of tax. So the tax filing requirements generally are there. Even if the requirements are not there, it's always advisable to file at least a tax return in India. This helps in maintaining tax continuity and reduces the chances of getting a compliance inquiry from the income tax department. One more thing I would want to say here is that non-residents should avoid disclosing themselves as residents or filing tax returns as residents, because that will create complications with respect to foreign asset disclosure, etc. in India.
I see. That's a very good point. Now, many visa holders are on their path to get their green card citizenship. Is there
Yeah.
anything that they should do, be proactive when it comes to that cross-border financial planning?
Yeah. Yeah. So here my point is that, as someone who is on the visa right now and on the path to go for a green card or a citizenship, the better idea is to stay invested in US, invest in US till the time of their stay in the US, because of certain how the IRS, the tax system is there, US tax system, which penalizes US residents from investing out of the US. So better idea is to continue investing in the US, and if at a later time or later date the GC doesn't materialize and they return to India, they can then decide to tax efficiently shift a portion of their investments to India, keep some in the US. So that strategy they can design at that point. Right now their focus should be first to have their insurances in place, their contingency fund in place, and then to have their investments in US, focused in US. That would be my suggestion.
Got it. Makes total sense. And we will
Yeah.
definitely get back to that. Now, you did mention insurance, so I just have to ask, how is India taxation viewing US life insurance death benefit? For
Yeah.
example, a lot of clients get that and they list a family member or someone else as a beneficiary to their US life insurance policy. How is India going to view that death benefit in form of taxation?
Yeah. So I'll just explain first the tax aspect of it. That as regards Indian tax law, there is as such no bifurcation between Indian and foreign insurance policies. So as regards death benefits, the death benefits are exempt. As regards maturity benefits, till there have been policy changes or tax law changes in 2003, 2000, uh, I think 14, 21. These are changes are there. So the position as it stands now is that if the annual premium is less than 10%, and the annual premium aggregate of the annual premium is less than 2.5 lakhs INR for ULIP policies, and 2.5 lakhs for traditional policies, then the payout will be exempt. Otherwise, it will be taxable. So death benefit is totally exempt, and the maturity benefit is exempt subject to conditions.
I understand. Okay. So One common strategy that a lot of my clients utilize is setting up life insurance as a form of retirement planning. Some of the policies do build cash value that can be taken income tax free in the US. How is India going to view these
Yeah, yeah,
funds?
I'll tell you. So what happens is that when a person returns to India, right,
Hmm.
he or she gets a certain period, which is like it may be 0 to 3 years, right? There are certain conditions. That period is called resident and not ordinary resident. That is the residential status. It's a kind of an intermittent status before he or she becomes a full resident. So in that period, if he or she gets anything, it is totally exempt. I mean, this is not taxable, right? After once he enters the ROR status, resident and ordinary resident, say 2 years after return to India, after that, death benefit is always exempt, but the maturity benefit may be taxable if those conditions are not met. So one
Oh, I
condition is
see.
the 10% thing. The second condition is the uh, uh, 2.5 lakhs or 5 lakhs. But here, please understand that there are rules got changed 2003, 2014. So there was a grandfathering benefit that was given. If it's a pre 2003 policy, then there is no issue. Everything is exempt. So that
Oh,
evaluation has to be done as to the specific policy, what is taxable, what is exempt.
that's a very, very good point. Okay.
Yeah,
So talking about the life insurance, how are all of the other retirement accounts treated? I have a lot of clients who
right,
max fund their 401k, Roth IRA if they qualify. How are those
right.
treated?
Right. I'll tell you. So basically, with respect to 401k, traditional IRA, Roth IRA, HSA 5 to 9. Now, see, India doesn't recognize these investments, right? Similarly, US doesn't recognize Indian PPF, EPF, and other things. So now here, the taxation is unclear till RNOR status, right? There, everything is exempt. I mean, there's no tax. But once the
Hmm.
person enters ROR status, the view that can be taken is that the underlying investments have to be seen. Now, if you're like 401k has stocks, right, within it, and you
Hmm.
withdraw from the 401k, then accordingly there will be a capital gains taxation as per the Indian tax law. US will
Okay.
have its own taxation. US will tax the entire amount, right? But India will have the right to tax the income. Good thing about India and US is that there is a foreign tax credit that is available, so you don't pay double taxation. You don't pay double tax. If
Okay.
US has charged, India will get give you the credit. If India charges tax, US will give the credit. So that DTA is in place.
Got it. What about Roth IRA accounts? Here in the US, they are typically income tax free. How is that viewed in India? Is it the
Yeah,
same?
yeah, exactly. This is very, very, very good question that you've asked, and this is very relevant because Roth IRA, the view, the mindset with which it is invested, that it is out of the post-tax money, right? As a US resident
Mhm.
that you have invested, and it's a very good investment, right? But once you return to India, we think that everything changes because India doesn't recognize the tax-free nature of Roth. So for India will treat Roth underlying investments as taxable when you sell, right? So it is like it becomes a kind of a taxable account. The tax advantage is lost once you return to India and enter
Mm.
the ROR. So the strategy that one can do, and this is again, it is
Mhm.
subject to detailed analysis, but till, I mean, even within being a US resident, Roth, if you're planning to return to India, can be avoided or can be liquidated within end of the RNOR status. And then when you are living in US, apart from contribution to the K, which is definitely a very good investment because it gives you tax deductions, you can consider taxable accounts, right?
Mm.
Instead of the Roth, right? So if the plan is to return to India.
That's very, very interesting because typically if someone is staying here, I would say, try to utilize any tax-free advantage accounts that you can, but that's bring
Exactly.
a very interesting point if you do return.
Yes,
Another thing
exactly.
that I want to touch on is how is India viewing trust? I have a lot of clients here, young families, where they have no extended family in the US except husband, wife, and kids. So naturally, they want to set up a living trust to help preserve assets. How is that viewed?
I think your question is the revocable trust. Like you are asking about the trust
Yes.
question. I couldn't hear you properly. Yeah, yeah. So revocable trust again. See, revocable trust is a very good way to avoid probate in US if you especially have real
Hmm.
estate in US. Now things change. Once you return to India, a revocable trust, India will see the revocable trust as per its own laws, right? In India, we have separate tax treatment for revocable trust. It's basically it's like a grantor trust, right? The income is like, if I have a revocable trust, the income will be taxed in US. In your hands, it will be taxed in India also. India also follows almost the same system for a revocable trust. You can have the revocable trust, and to avoid the probate, if you have a real estate. But the important thing, please keep in mind, is regarding disclosure of the incomes and the asset, the trust, in the Indian tax return once you enter the ROR status. And that goes not only for the trust, it goes for all of your foreign assets. If you miss the disclosure requirement, there is a flat 10 lakh penalty. And the
Um,
Indian government is aggressively looking into cases where Indian residents have not disclosed the foreign assets, non-Indian
oh,
assets.
oh,
So that
okay.
disclosure requirement has to be very, very meticulously complied with. Yes, you can have the revocable trust. See, again, in India, we have a law called Foreign Exchange Management Act. So this law actually governs transactions of Indian residents with anyone outside India. So once you are an Indian resident, you fall in that trap. Then you have to only do transactions which are allowable. But there is a carve out that is there, which says that if you have earned money outside India as a non-resident, you practically can do anything with that money. But the Indian government will not touch that under FEMA. So that benefit is there. So the trust structure can stay. And if you want to continue with your US property, only thing I want to say here is that please take into account the section 121 exclusion with respect to your property. Once you return to India, if this was your principal residence and you miss the 2/5 year rule, then you lose the chance of getting a capital gains exemption of up to 5 lakh under section 121. So many of the NRIs who return to India, they then just realize that they just missed that 2/5 year rule under 121. So that has to be carefully done. Either you keep the property, have it in the trust, or then you decide to liquidate it within
Um,
within the RNOR. Don't let it go till the ROR, because then India will also tax it.
Very interesting point. So what I'm hearing here is like a common theme. It's just make sure you pre-plan before you return to India
Very exactly. You said
and
it. Yes.
figure
You
out
have to
how to.
be, yeah, yeah, exactly. So you have to have your plan before you return to India. It's like what the mistake people do is that they return to India and then they start thinking on those things. And by that time, the RNOR window is also expired.
It's
Then,
shrinking.
then there is very
Okay.
little tax planning possibility. Once you are in the ROR, then it becomes difficult.
Oh, very, very good point. Very good point. One thing also that I just need to touch on very quickly is, like I said, a lot of the clients are living in the US, but they have extended families in India, parents, siblings. How is inheritance treated? If someone inherits any property assets in India, but they are not living in India, is there going to be any reporting complications, taxes?
Right. So here again, in US, let's talk about the situation of a US resident inheriting from a parent in India. So definitely these transactions per se mostly are allowed. Relative to relative transactions are allowed. And when you inherit, see, as regards, there are two things. One is gift, second is inheritance. So let's talk about inheritance here. What's your question is? So US at a federal level doesn't have an kind of an inheritance tax, but some US states have inheritance tax. So one thing that needs to be planned very carefully is that if you have substantial wealth and you expect an inheritance, the child expects an inheritance, then one has to be careful of the location of the state where he or she is living, right? Because then there is the inheritance tax. The thresholds are far less than the US, maybe estate tax thresholds. So that has to be considered. Then there is the requirement of Form 3520 in US. If you receive a gift or an inheritance more than US dollars 1 lakh, then 1 lakh is 0.1 million. So then you have to file a 3520 with the US IRS. If you fail to do that, there are penalties. So you should not kind of miss that. So these things need to be kind of kept in mind.
So, Abhinav, thank you so much. I feel like we can talk about this for hours. And there's
Sure. Thank you.
definitely a
Thank you so
lot
much.
of things for people living in the US to consider should they return to India.
Sure.
If they need
Sure.
some additional information, how can they find you? How can they reach you? I know you've written a book on the topic.
Yeah, sure. So basically, I have a website, abhinavgulechha.com, and there is a consultation page where they can get the full details. Otherwise, also they can reach me on email, contact@abhinavgulechha.com. So that's the way to reach me.
Okay, perfect. And I will include all of that information in the description of the video just so people can easily
Okay.
find
Thank you
you.
so much. Thank
I
you so
want to
much.
thank you one more time for taking the
Thank you
time
so
to
much.
go over this. Like I said, I feel this is a topic that we need to definitely do a follow up because there is a lot of questions that will come
Definitely.
out of this.
Definitely, and I will say thank you to you for your efforts in this direction, for helping your clients understand more on the cross-border implications, which will help them in their financial life. So, thank you to you for
Thank
having
you as
me.
well. Okay, I hope everyone has a great rest of your day. And if you need to follow up or you have any additional questions that you would like us to answer, you can reach out to me. You can reach out to Abhinav. I hope you have a great rest of your day.